great quotation number 1. This one comes from William Shakespeare. I bet you've heard of him. In fact, I hope you know that the Motley Fool's corporate name comes from Shakespeare. That was from Act 2, Scene 7 of As You Like It, but this time I'm going to A Winter's Tale, which is a tragi-comedy. It's really one of my favorite plays of all of Shakespeare's. It doesn't tend to get put on as often as something like Romeo and Juliet or Hamlet, but Winter's Tale, no spoilers, starts with a tragic few acts and then ends with a comic few acts. And it's a wonderful story, and one of Shakespeare's most famous stage directions is the quote that I'm pulling from A Winter's Tale, and here it is. Exit, pursued by a bear. There's some debate as to whether in Elizabethan times they used a real bear on stage to chase Antigonus, the actor, who's exiting, being pursued by a bear, or whether it was just an actor in a bear costume. And I'm sure in centuries since, there's probably been a little bit of both. I personally would love to see a live bear on stage, but not if you're Antigonus, because Antigonus, as he gets chased off stage, that's the last we ever see of him. He is presumed dead, presumably by that bear. But why would I lead off with exit, pursued by a bear, and call that a great quotation? Well, in a little bit of, I would say, linguistic legerdemain, I made this an epigraph in the very first edition of the Motley Fool Investment Guide. Now, an epigraph, as you may well know, is a quotation that'll lead off a chapter or a section or a part of a book. And I thought this is the perfect one to lead off our chapter on selling stocks and selling strategy. Exit, pursued by a bear, because of course it's a wonderful pun on bear markets, which is why I wanted to talk a little bit here at the outset of this podcast about bear markets. You know, most bear markets last somewhere between 12 to 18 months. They're much briefer than bull markets. Bull markets run over years. Bear markets are usually counted in months, but as I've often said in the past, stocks go down faster than they go up. And so when bear markets strike, like a bear strikes with its paw down, stocks go down, and often a lot faster than you or I would like. And I would say right now, here at the end of October 2018, I think we might be in a bear market. Now, how do I conclude that? Well, I look at my own scorecard, picking stocks for Motley Fool rule breakers, and I look back over the last several months, and each of my picks is down and losing to the market, in some cases 20% or so. And when I see stocks lose about a fifth of their value, and it's happening fairly consistently, I start going, well, when did that start? And for me, it was around mid-June. So doing quick math on my own family portfolio that I manage, I'm down about 15% from June to this week. So that's not a great performance. That's definitely a time that I wish the market hadn't done that over the last several months. Although when I look at the S&P 500, which is a more broad market measure than my family portfolio or your portfolio, I'll note that actually the market's about where it was as of June. This week, as of mid-June, it really hasn't moved, but it has surged higher than that in the meantime and then fallen down over the last month. So those keeping score at home looking at the broad market will note that over the last 30 days, the market's down about 7% as I tape this podcast here on Tuesday, October 23rd. So I think, at least for me and my style, for the rule breaker investing approach, I think we're in a bear market right now. And it's been lasting a few months, and some of the damage has already been done, and there'll probably be some more damage done. We'll see. I'm not one to make big market calls, and I hope you realize that when I say that I think we're in a bear market, it doesn't change how I invest, and I'm certainly not trying to alarm anyone. And I'm also just guessing, because we really never know until we look back 12 or 18 months later and say that was a bear market. Of course, people are constantly predicting where the market will go, and a lot of people thought there'd be a bear market in 2013 and 14 and 15 and then 2016 and then 17 and 2018. So there's always a lot of guesswork, but we really only know when exit pursued by a bear matters once it's already happened. So I wanted to lead off with exit pursued by a bear because I think it's a great pun for investors pulled right from my favorite playwright, William Shakespeare. And I want to point out what actually ends up happening to Antigonus when he exits pursued by a bear. And as I mentioned earlier, no spoilers really, but he'll never be seen again. And I don't think that's a great outcome for you or me as investors. So when I see a bear, I don't exit. And I'm here to suggest that you should not exit either unless you're overinvested, unless you've borrowed on margin, which you should never have done according to us here at the Motley Fool for the most part, or if you really did need the money for something else like a home payment or something else in the next 3 years. We've always said here at Fool HQ, we're now in our 26th year as a business of saying this, that you as an investor should only have money in the stock market that you can afford to lose and that you won't need for 3+ years, because the next 3 years, any given 3-year period could be bad, and I'd hate to think that you were risking money that you actually needed for something else. Of course, we're always playing the only game that counts here at the Motley Fool, and that is the long-term game. So exit pursued by a bear is not only a fun pun uniting Shakespeare with investing, but it's a warning to us as investors not to exit most of the bears that you see over the course of your life. And again, if you're making a lifetime commitment to being invested in the stock market, which is, I think, one of the best decisions you can make, and history and data proves that out, then you'll recognize that almost every bear you see, you should stay on stage. Quotation number 1. Before I go to great quotation number 2, I should mention that I think a lot of people, in particular in recent years, have feared a bear market because they think it could be really bad. And why is that? Well, the last couple of bear markets have historically been horrible. 2008 and 9, and then, of course, 2001. Those two markets, the Great Recession and then the dot-bomb bomb, really saw the markets lose about half their value, in some cases more if you're counting the NASDAQ. And so great companies like Amazon, I remember back in 2001, too, went from like 95 in 2000 down to 7 at its bottom, I think, in 2001. The numbers are right around there, but my point is that was a drastic drop in one of the great companies of our time. And I think it's easy to be looking in the rearview mirror and think, well, that's what bear markets look like, but that's really not the case. So I think people are probably overrating and a little bit too afraid of the idea of the next recession or the next bear market. A thought.